Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on Nigeria's debt stock as of Q2 2023 and its implications. The Debt Management Office, DMO, and the National Bureau of Statistics recently published Nigeria's public debt stock as at the second quarter of 2023. The report showed that Nigeria's total debt stock, domestic and foreign, was at 87.4 trillion naira or $113.4 billion. This implies a year-on-year increase in public debt of 103.9% or 44.5 trillion naira from 42.8 trillion naira in Q2 2022 to 87.4 trillion naira in Q2 2023. In dollar terms, the total debt rose by 9.8% year-on-year from $103.3 billion in Q2 2022 to $113.4 billion in Q2 2023. The significant rise in the debt position in naira terms can be attributed to the 46.1% devaluation of the naira at the official window to 770 naira per dollar at the end of June 2023 from 415 naira per dollar in Q2 2022 and the recent inclusion of the CBN Ways and Means 22.7 trillion naira. Furthermore, the report revealed that domestic debt accounted for 61.9% of the total debt stock at 54.1 trillion naira, while external debt made up the remainder of 33.2 trillion naira or 38.1%. A breakdown of the total domestic debt as of June 2023 showed that federal government Nigeria bonds was highest with 87% or 42 trillion naira, followed by treasury bills with 10% or 4.7 trillion naira. The substantial rise in the proportion of the FGN bonds is due to the securitization of the CBN Ways and Means of about 22.7 trillion naira. Given the consistent rise in the debt stock, expenditure on the debt service has risen in tandem. The federal government expended about 2.1 trillion naira in debt service for domestic and external debts in the first 6 months of 2023, relative to prorated 3.2 trillion naira in the approved 2023 budget. The huge resources spent on debt service, along with the associated risks, especially exchange rate risk on the country's portfolio of dollar-denominated loans, raises questions about the sustainability of the country's debt. Debt sustainability refers to the country's ability to finance its debt obligations without external help. Two standard metrics are used to measure debt sustainability: the debt-GDP ratio, which compares the size of a country's debt to its GDP, and the debt servicing to revenue ratio, which captures debt servicing to actual revenue in a given period. The federal government's debt position at 40.5% of Nigeria's GDP as of Q2 2023 has exceeded the DMO's acceptable debt limit of 40%. On the external front, multilateral loans from the World Bank and African Debt Bank groups accounted for 48% of external debt, followed by Euro bonds, which stood at $15.6 billion or 36% of external debt. Meanwhile, bilateral debt was at a total of $5.5 billion or 13% of the external debt, mainly split between China, Exim Bank of China, at $4.7 billion or 85.4%, and France, Agence Française Development, with $573 million or 10.3%. By state, Lagos, Delta, and Ogun topped with a total domestic debt of 996.3 billion naira, 465.4 billion naira and 293.2 billion naira respectively, from a total domestic debt position of 5.8 trillion naira for states. A revenue of the state's external loans, mostly multilateral loans, shows that Lagos, Kaduna, and Edo recorded $1.2 billion, $569 million and $258 million respectively out of total state loans of $4.3 billion. Implications of high debt position. 1. Economy. The significant rise in federal government's debt implies that the government's resources will be diverted towards interest payments, leaving less resources to be invested for growth. Moreover, investors may be skeptical about the government's ability to repay debt and demand even higher interest rates, especially for external debt. A rapid increase in rates would make the debt more expensive and achieving debt sustainability more difficult. 2. Fixed income. A higher debt position is expected to push yields up in the fixed income space, making newer issues more attractive. This presents good opportunities for investors in mutual funds, especially fixed income, as the return is expected to improve. The need to attract FPIs may necessitate a further increase in interest rates. 3. Eurobonds. In the face of high interest rates in the US, it is important to note that subsequent issuance of Eurobonds will be conducted at a higher premium to attract investors. Although yields appear attractive in the secondary market, we advise investors to approach the market cautiously. 4. Businesses. With the federal government competing for funding with the private sector in the capital markets, investors would demand a higher premium from corporates as government instruments are considered risk-free. Rising interest rates will limit new investments in business equipment and other operations as businesses will face a higher cost of capital, which could harm innovation. 5. Stock market. Higher interest rates will increase companies' borrowing costs, thereby reducing their declared profits and returns to shareholders. Additionally, higher interest rates in the fixed income market make the stock market less attractive due to the volatility. In summary, subsequent borrowings should be strategically channeled towards the productive sectors rather than recurrent expenditure. This is to increase our ability to generate revenue to repay the debt. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.